Hello, everyone, and thank you for joining us. My name is Maria Pagura, and I head up AgriFin's Knowledge and Networks program. On behalf of the entire AgriFin team, I would like to welcome you today to today's webinar on lending to agricultural clients using a cash flow model, Lessons from Madagascar. As many of you know, AgriFin aims to catalyze learning about successful agricultural finance models through the sharing of practical information and the fostering of peer-to-peer exchanges. Our webinar series is one way that we accomplish this goal. Through this series, we engage agricultural bankers to share their insights and experiences with you on specific products and processes that work well in their respective markets. Today, I am very pleased to welcome our guest, Mr. Quentin De Vreese, Deputy CEO and Credit Manager at AXA Bank in Madagascar. In today's webinar, Quentin has graciously accepted our invitation to share about ABM's experience in using the cash flow-based lending model, in particular to finance smallholder farmers. He will talk to us about ABM's motivation for using this type of methodology and its benefits for the bank itself and also for the clients. He will walk us through an example of how the model works in practice and then talk about the key lessons that they've learned and how they've had to refine the model over time and what those lessons may imply for other financial institutions as they try out to develop a similar model. Now, before we get started, I would just like to let everyone know how things will operate in the next hour. As usual, we'll begin with the speaker's presentation. Quentin will speak to us for about 20 to 25 minutes. Today, we have a special, that will be followed by a special showing of a new video clip about ABM's model. Now, this video, as many of you may have seen from the promotion of our new agricultural lending video series, this video is part of that new series. And I'll speak to you more about this video and the other videos in the series at the end of the webinar. So we'll showcase that. It will be about 2 to 3 minutes following Quentin's presentation. After the video, we will have a Q&A session with the speaker, and I'll facilitate that. For the Q&A session, please remember to send in your questions throughout his presentation, and myself and Valdetta will be collecting them and organizing them to conduct a facilitated Q&A session. That text box or chat box is located in the lower right-hand corner of your screen. I think that is all for now. That's how we'll proceed. And right now, I would like to turn it over to our guest, Quentin, to begin his presentation. Thank you.
Thank you very much. I would like to thank particularly AgriFin for giving me the opportunity to present our agricultural financing methodology and exchange about it. The topic I was asked to present is lending to agricultural clients using a cash flow model, lessons from AccèsBanque Madagascar. In the two first slides, I will briefly present AXA Bank and the agricultural portfolio. I will continue with the introduction and the description of the cash flow-based lending technology for agricultural clients. And I will finalize the presentation with the lesson learned, challenges, and conclusions. AXA Bank is one of the 11 fully-fledged banks in Madagascar and was created in 2007. The bank, from the beginning, focuses on a commercial base on serving micro and SME clients and their families. To give you a rough idea, the bank represents about 2% of the banking sector in terms of assets, 13% in terms of clients. And looking at the microfinance sector, we can say ABM shares about 19% of the total sector in terms of credit portfolio volume. The main shareholder is Access Holding, a strategic investor in micro and SME finance based in Germany, which is also the main shareholder of a network of banks called AccèsBanque, located in Africa, Central Asia, and Brazil. Other shareholders are KfW, AFC, Triodos Doon, and Société Générale, the only local shareholder. The bank does not only offer credit products. Our clients also have access to various accounts, current accounts, savings, term deposit, and money transfers as well. This allows us to fund the credit portfolio. The total credit portfolio size is currently $30.2 million. And the bank's core credit technology is based on individual lending with, in almost all situations, a site visit organized, cash flow and balance sheet assessments. Although we also have specific products which are based on other principles, such as our agricultural warehouse receipt loan. I move now to slide 3. This is a brief presentation of our agricultural portfolio. It represents 18% of the total bank's portfolio. $5.2 million and 8,444 clients, split up into 3 main products: micro, SME, and what we call the specific agro product line. This specific agro product line represents 6% of bank's portfolio, is made of roughly half of the agricultural clients, 4,316, and it is also the product line, the only one using the cash flow based method, the agricultural cash flow based methodology that I will present today. The total agricultural portfolio, as you can see in the pie on the slide, is composed of 47% of producers, out of which 2/3 are small cultivators. The rest are small livestock farmers, mainly chicken, dairy, and pig. Regarding cultivators, it is mainly rice farmers. The traders are mainly represented by collectors and other retailers, and the portion of input suppliers is rather small in our portfolio. Only 7% of our agricultural portfolio are processors, which are basically dairy processors and rice shellers. The more specific agricultural product line is, as I mentioned earlier, made of rice cultivators for most part, who mix subsistence farming with small-scale production of cash crops such as bean, tomatoes, potatoes, etc. This represents 98% of the specific agricultural product line based on the agricultural cash flow. The rest are made of livestock farmers having a higher seasonality. For 90% of these clients, the purpose of the loan is working capital. And as we can see as well, the portfolio quality is rather good, better than the overall bank's par. So why did the bank decide to implement such products? First of all, Madagascar is a rural country. 70% of the Malagasy population is employed in the agricultural sector, and agriculture as well contributes to about 30% to the country's GDP. So it's making sense for a bank like ABM to be interested in, obviously, in agricultural lending. It was quite obvious that the standard cash flow-based micro technology was not really adapted to small agricultural clients. What I mean here is that monthly repayments starting immediately after loan disbursements require having rather fast turnovers and regular cash flow of nearly the same level, and this is not, does not fit with the irregular investment returns due to the agricultural activities, and especially the mismatch between the planting season and revenue at the time of harvest. So we had to find another methodology. The third reason is the fact that frequent loan repayments is at the core of the standard micro technology, and it was opted not to give up this principle, as it allows to keep in contact with the clients and to intervene as quick as possible if anything happened. So for us, it was a good way to reduce the risk of non-payment and to keep in touch with our clients. Finally, a more comprehensive approach was judged appropriate, especially in the beginning, to capture the main risks. Also allowing easy cross-checking and consider the fragility of the entire farmer's financial situation. As well, most Malagasy farmers in the central region have diversified sources of income and cultivate various types of crop. So it was necessary as well to align our methodology to these specificities. In order for us to differentiate an agricultural case, at least the case that will be considered in the agro product line from a standard loan, micro or SME, first of all, the income generated needs to be through agricultural production. We talk here only about primary production, cultivators, livestock farmers, mainly. Also, the client must invest in agricultural production, and I will already move to the next slide. Here. Indeed, they must invest in agricultural production because the agricultural cash flow is based on a projection, minimum 12 months, in order to determine the repayment capacity. So it means here the amount that the client is able to use for loan repayments per month. Using a past cash flow, as it is done for standard loans, for micro and SME, wouldn't work and wouldn't really make sense neither, as clients are usually rotating crops from a year to another. As well, commodity prices can vary. So the loan officer, along with the client, establishes what we call a crop calendar, which is at the heart of the agricultural cash flow-based methodology. It evaluates the proper timing for plantation and harvest, all related costs and revenues for each activity, and this is done on a monthly basis. Later on, the data is transferred to ABM dedicated tool that I will show you in the next slide. Most farmers in the central region of Madagascar diversify their agricultural activities, and the climate as well allows them to have counter seasons, so they can use their land for several cultures. This exercise is done for each activity, including non-agricultural activities. And of course, the higher the farmer is diversified, the less likely he will face months with negative repayments capacity. The irregular monthly repayment capacity assessed allows the bank to be more flexible regarding repayment schedule. The bank allows 4 grace periods for principal only. So it means that even though the grace period is given, the client still need to come to the bank to pay the interest, and 3 grace periods maximum consecutively. Another main difference is the frequency and the purpose of the client visit after loan disbursement. The loan officer conducts a mandatory follow-up visit, usually 2 to 3 months after the loan disbursement. This exact timing is decided by the committee based on the crop calendar. And the goal of the visit is to verify specifically the respect of investment plan. Some additional key features for the agricultural product line linked to the product and also internal organization. First of all, it's a specific product line managed through specially trained agricultural loan officers. There is both internal and external trainings required. The internal training prepares the loan officer for carrying out agricultural clients analysis, procedure, use of tool, etc. And all loan officers have to go through the standard micro training before taking the specific internal agro training. But in addition, they also receive an external training at an agricultural training center, so they understand the dynamics of the different types of crops in the region. Loan officers travel to clients' farms by motorcycle. They share motorbikes in the branches, and also the bank participates in the purchase of their own bike. ABM serves clients within 30-kilometer radius of the nearest branch. It represents a period of 30 minutes maximum on a main road and can go up to 1 hour maximum on a secondary road. The higher operational costs of the product line require as well setting slightly higher pricing. We are on average 10-15% more expensive, and the average loan is much lower. It's half of the size of the micro product line. We have an average of roughly $500 per loan, with a minimum of $165, and we can go up to $2,300. Okay, slide number 8. In the next slide, you can briefly have a picture of the loan process at the branch. Very important for ABM. We consider the loan process as a recurring cycle, which means that we believe in the long-term relationship that we establish with our clients, and the loan is very much linked with the calendar year. So clients are taking repeat loans. First of all, the client applies for an agro loan at one of the branch. The loan officer visits the borrower's house and the field to establish the crop calendar. He inspects collateral, verify the ownership of the collateral as well. Loan officers enter the borrower's information in the dedicated tool and make the analysis. Application is then presented to the credit committee, and the borrower is notified immediately after a decision is made. Loan is disbursed to the client at the branch, so all this process is made at the branch level, and the clients make monthly repayments, and as I told you earlier, the loan officer conducts a follow-up visit, usually 2 to 3 months following disbursement, to check for use of loan proceeds. Okay, here's an example of the tool that we use to make the yearly projection. I know it's quite small. It's also written in Malagasy. But on the first line, the future crop revenues are calculated month by month, and for each crop, the projected expenses are also mentioned, and additional income from other activities are also added. Also, and this is quite important, the household expenses are considered, as there is no separation between the activity and household finance. We consider the overall situation of our client. And at the end, the repayment capacity is calculated by netting all the expenses and revenues. Each information provided by the client is, of course, cross-checked. First of all, with the knowledge of the loan officer and specific cross-checks that he knows. But additionally, as well, we compare the information with the regional information coming from NGOs and Farmers Association in Madagascar, which have been very useful. In addition to the cash flow, we also use a simple balance sheet for each borrower. The current assets are mainly composed of savings, which is the cash kept at the client's home, store crops and rice. Rice is considered apart. Crops to be harvested. We calculate that as the amount of investment costs already incurred. And the fixed assets include, for most part, animals. Based on we assess the value based on the size and the age, and we verify the ownership through a registration book that is available for cows and zebu. We include all material used for working in the field, and even the land if we have evidence that the farmer has purchased the land in the last 5 years. We also consider if rented land, if the farmers has rented the land several years in advance. Regarding the liabilities, it's quite difficult for to be able to detect any liability. Debt from other institutions can hardly be seen in the central of risks. So the loan officer has to develop the skills to be able to get this information directly from the client. As mentioned as well in the slide, in most cases, the land is hereditary with no documentation proving the ownership. Also with values that are very difficult to determine. We include as well collateral. It's obviously rather a way to have some sort of pressure rather than securing the loan. It's clear that small farmers, more than micro clients, have little collateral and of questionable value. Most often, what is included are household items, basic equipment, or even cattle. Of course, we do not consider the essential items like kitchen, utensil, beds, etc. Cattle used as collateral are recorded as such in a small registration book with a stamp on it, and it's done with the presence of the community leader. Two basic ratios are used to avoid over-indebtedness. We calculate the debt service ratio, so the installment on repayment capacity shouldn't go higher than 70%, and the solvability ratio, so we compare the client's equity to total debts, including as well the loan amount proposed, and this shouldn't go, so the equity should never go higher than the total debt and the new loan. I think I skipped one slide here. Yes. What did we learn since we established the product line already 5 years ago? I tried here to group the main lessons that also can be useful for others. First of all, we can say that lending to small farmers in Madagascar is not riskier than agricultural borrowers when they're adequately addressed. Of course, under the assumption that there are no serious climatic events, but the portfolio quality on our side is even significantly better as compared to the bank's overall portfolio at risk. We have seen, and additional surveys have also been made at the bank regarding that more flexible repayment schedules are adapted to the client's cash flow seem to increase the portfolio quality. Through this new product line, we managed to attract additional customers around the branch existing network. Branch opened also serve traditional micro clients. So it is possible to combine the traditional micro product line with the agro specific line. Training is key. You need to have experienced staff who know very well the agricultural sector, and most important as well the regional specificities. A significant part of our agro loan officers have a background in agronomy. And last lessons learned. Well, it seems that personal risks and events related to the household, sickness, unpredicted family events, the sickness of the animals as well, seem up to now to be the major factors influencing the agro portfolio quality as compared to climatic risks that we might consider as being one of the big risk for agriculture. Nevertheless, we encounter many challenges with the lending technology. First, and I believe it's one of the major weaknesses of this technology, it is very work-intensive and time-consuming. Also, the average loan amount disbursed is smaller, more than 50% smaller, as I said, than the standard micro product line. This is due first to the nature of farming here in Madagascar. Also coming from the productivity, the yield is very low. We have on average 0.5 ton of rice per hectare. And this is due to the methods used, the use of fertilizer, irrigation mechanism, equipment used, etc. So there is much room as well here to increase the farm sizes. The methodology requires a lot of specific regional and sub-regional knowledge. This is quite challenging because each time we decide to open operation in a new branch, all the technical information can significantly change. Finally, once we really want to increase outreach and serve the majority of farmers in the region, it is clear that distances and very low population densities, also combined in Madagascar with a lack of proper infrastructure in roads, becomes a major issue. To that regard, we have also worked on developing different type of model for rural branches. I will conclude by saying that after 5 years of experience in using this lending methodology, we can say that the model works to properly assess farmers and the risk linked to it. And the product line is also generating small profits. I believe it is replicable in regions where farmers diversify income sources. It is not the case. If it is not the case, or if the farmers' overall returns on investment is too seasonal, probably other methodologies might be more appropriate and certainly less work intensive. There is an obvious need to simplify and to automatize the methodology. We have now gathered a lot of data to allow us to move towards scoring system, or at least more statistical-based approaches that would allow us to reduce risk and as well reduce transaction costs. We are currently in the process of developing such tool. Technical cards are also a possibility, but a challenge as well, because of the variety of crops we work with and the sub-regional differences. Farmers work from 4 to 11 different type of crops in the same time. Nevertheless, there is still room to automatize more the ways technical data is processed in our technology. In addition to simplifying this methodology, exploring other ways of reaching out farmers is necessary to overcome the higher transaction costs. We have developed a warehouse receipt loan product, for example, for rice. So the loan is approved based on the quantity of rice brought and stocked by the bank. With the support of AgriFin, we are also in the process of setting a specific value chain financing product linked to the dairy sector. A stronger cooperation with our existing clients involved in collecting agricultural goods as well gives us great potential. And finally, last but not least, the development of alternative channels is certainly key to increase outreach in the rural remote areas where most farmers live. So we are as well in collaboration with Mastercard Foundation to develop such product in the next years. Thank you very much.
Quentin, thank you for a very interesting presentation. You highlighted many interesting features of your lending methodology and also highlighted other things that you're working on, which we'll circle back to. What I'd like to do now is turn it over to the video as promised. I wanted to show you the short video clip that is now, we just launched yesterday or the day before as part of the World Bank AgriFin Agricultural Lending video series. And these videos are easy to access. They're on our website, but they're also easy to accept through AgriFin apps that we've developed. So here is the video. Is it big?
AgriLoan is a product introduced by AccèSBanque Madagascar, designed to serve thousands of small farmers. It involves ABM lending directly to smallholder farmers based on a cash flow methodology. Here's some of the loan's key features. Farmers should have a diverse agricultural income, ensuring more frequent income and less lumpiness. For example, farmers will have both crops and livestock. AgriLoans are only to be used for farm-based income-generating activities, and these activities need to be the primary source of repayment. At least half of the farmer's income must be derived from agricultural production. Repayments are due monthly, although the amount repaid each month will vary to reflect the farmer's cash flow. Repayments must be paid in person at the branch to maintain contact between ABM and the borrower. and loans are based on cash flow forecasts at the time of loan agreement. ABM views the loan process as a recurring cycle. A system of graduated incentives, such as reduced interest rate charges, rewards a client's good performance, supports client retention, and ensures that the bank's product remains attractive. Here's how the agro loan cycle breaks down. The process begins when the client applies for an agro loan in branch. The loan officer then visits the borrower to establish the crop calendar, inspect any collateral, and verify ownership. Next, the borrower's information is entered into a spreadsheet-based cash flow analysis tool, and the loan officer analyzes the ratios. The application is then presented to the credit committee, and the borrower is notified immediately once a decision is made. If successful, the loan is disbursed to the client at the branch, and they then begin making monthly repayments. After 2 to 3 months, the loan officer conducts a follow-up visit to check the loan proceeds are being used correctly. And finally, if all the previous steps have been successful, the client repeats the loan. The heart of the CFB-ACA methodology is the crop calendar. Agreed between the loan officer and their client, it represents a projection of the timing, investment costs, and potential revenue of the client's household and farm activity. The calendar helps to calculate client repayment capacity by netting all revenues and expenses. In addition to the information provided by the farmer for revenue forecasts for each crop, ABM performs a cross-check using market data from the region in which the client lives.
Great. So that was the video that we wanted to share with you. I do encourage everyone to hop on our website, download it, share it with your colleagues and friends, or get on one of our apps that we've developed for it. And we'll talk more about that at the end of this webinar today. What I'd like to do now is to shift over into the questions that have been coming through the chat box and facilitate those questions, engage with Quentin on that. Quentin, if you're ready, we'll go ahead. Looks like you are. Unmute him. Thank you. So the first questions, Quentin, were a bit on the enabling environment, a bit on the clients, and I wanted to touch on what you said about climatic risk and that not being a problem. The first question came in and said, are there any policy considerations with the government or any governing authorities needed to be in place to specifically endorse or complement what you're doing, what AccèsBanque is doing on the agri-financing? Or is this something that any bank can do? They really don't need any specific enabling environment or policy environment?
Of course, the government policies are extremely important as well. I mentioned in my presentation the challenges that we are facing with the infrastructure to reach our clients, even when it's not so far away in distance, but in timing, it takes a long time. Additional policies, well, I wouldn't say that climate is not a risk. I'm saying that up to now it doesn't seem that it's affecting our portfolio so much, but nevertheless we know that in Madagascar there are invasion of locusts, very frequent cyclones as well. Cyclonic periods from January to March generally, and anything that can be done to face these challenges coming from the government, of course, supporting a lot the financing of these clients. Especially anything regarding low cost, we have been affected in the last years, and cyclones.
Quentin, on that, that's very interesting what you say about the climate. I was struck with that in your comments in your presentation and now. It's not that there hasn't been. There's still variability in climate as there is anywhere. And what we're finding is probably a higher intensity of that variability. So how are your clients dealing with that? Is that something, like you said, is there a special fund that they draw upon, or are they just internally organizing their resources and paying their loans off, or are you as a bank having to restructure, rewrite, restructure their loans?
I think it's first of all comes from the nature of the crops they cultivate. It's mainly rice, and this somehow the season can be delayed. It can influence the overall production, but it is still to a certain extent working for them. And the second point is the fact that they diversify their income. So if there is an issue with one of the activity, they can still rely on the others.
Okay, great.
I think also what is really helping us in serving these clients' diversing activities.
Is there any difference between the crop calendar year on year in the areas that you're serving, or is those stay about the same of your clients? And where do the farmers put their stored crops? One of our participants was very interested in understanding a bit more about the client profile.
Okay. The crop calendar varies from a year to another because they do not always use the same land. So this can vary a lot. This is also the reason why we always work with projection and do not want to work with past information. At least to calculate the repayment capacity. Of course, we take the past information as well in consideration. Clients are keeping the rice. A big portion of the rice is also used for self-consumption. So they keep the rice at home and use it, and the rest they either keep it at home to speculate and wait until they can sell it at a slightly higher price, or they sell it immediately to collectors. And collectors are coming in the rural areas, collecting themselves the rice.
Thank you. I want to just before I move on to another topical area, there are several questions on costing and pricing of your products. But one question came in that was associated to our discussion on climatic risk that I thought would be interesting to raise at this time in the discussion. And that has to do with insurance. Do you offer your clients any type of insurance to deal with the climatic risk or that they face, or are you planning to do that, or is that available in your market?
We have been very interested in offering this type of product. We are not offering it for the moment. We have been in contact with several insurance companies. We are also interested with insurance linked to the animals.
Oh, yes.
Because this is affecting very much our clients. It's hard to find the proper product in the current situation, but we are in discussion with several companies. So I believe we might offer something soon.
Great. So let me move over to the issues of costing and pricing of your loans. You mentioned there's 3 or 4 questions that have come in on that, and if you don't mind, I'm going to ask you all of them, and you can respond to them. If you forget one, we can go back and forth. So the first one is on, do you follow a risk-based pricing model for the farmers? Or I know you mentioned the difference between your typical microfinance loan and your agri loan, but do you follow, is there any risk based on that client profile? Is it priced on the person's risk profile, or is it just a standard one for all small borrowers? That's the first question. Then the second question is, what's the gap between the agricultural pricing of the loan, and then I think you may have mentioned it, then your regular loans in the bank? And then the last question is, how long does it take for you to grant a loan to a farmer from the initiation to disbursement? And then what is the average loan size, the agri loan size to the farmer?
Okay. The price is, of course, it's linked with the amount. The amounts are much smaller, so we have to compensate with this smaller amount. The transaction are higher, so it's unfortunately, yes, it's a price based on the cost to make sure that this product line can be sustainable for the bank. So I strongly believe that by reducing these transaction costs, we will be able to offer interest rates that are lower. Regarding the agri loan size, it's around $500.
Okay. Good. Do you have? Yeah. Did you also mention the gap between the agri loan and your general loans?
Yes. It's as I mentioned, it's an increase of 10-15%. So not in. I talk about percentage. It's not in interest percentage, but an increase of 10-15% more.
Okay, great. Let me shift to the discussion to the implementation. We've worked with you for quite some time now. We've seen your evolution from how this product has evolved and other products have evolved. Could you give an audience an indication of really, if a bank was to start this from afresh, how long did it really take you to go from, initiation, pilot, to get the model up and running? And I mean to adopt the methodology in terms of what we're, to get it embedded into your credit policy and the processes that you had to refine or adapt, and also how long did it take to prepare the personnel? Could you speak a bit about that?
Mm-hmm. Sure. First of all, it's quite important to make a proper market survey to understand very well the specificities of the farming environment in the country. This can take several months. It depends on the resources available. But in order to prepare everything and train as well the people, you must consider between 6 and 1 year of preparation.
Mm-hmm.
6 months and a year.
Mm-hmm. Okay. And that's from start to finish to where it's really mainstream into the bank.
Exactly.
Okay, great. I had another question here about the information. You said this is a very intensive information gathering exercise. You said you relied on NGO and local institutions to verify the information you receive from farmers on their markets and the crops that they're producing. How much do have you systematized the information you gathered and share that across your organization? How does that work? I know you mentioned something about you're wanting to automate that. What are your plans moving forward to gather and manage that information in a more efficient manner, which would probably impact your transaction cost in implementing this model.
Mm-hmm. One of the big challenge with this data is the fact that it is varying a lot from a branch to another, from a sub-region to another. So it's very difficult to standardize that in our tool. We include that in our tool, but it's done at the branch level, or at least at the sub-region level. Sometimes 2-3 branches can rely on the same type of information. Yes, it's quite hard, especially if you and we are in the process of we continue to open new branches in new regions. So we always need to get the information specific to the region. And this is where NGOs and farmers associations are really helping as well, especially in the beginning.
Great. Quentin, I have a couple more questions. I think we have time for a couple more questions that I'd like to pose to you in this session that are very interesting. The first is on the currency risk that you may face in your operations. How is this risk assessed and who takes it? The questioner is assuming that you lend in local currency, but you may have hard lines of credit. You may have lines of credit in hard currency, euros or dollars. And how do you manage that? And then the second question is a little bit different, but I think it's more of an operational question as well. They'd like to know if there's any difference in the bonus incentive schemes for agri-loan officers as compared to urban loan officers or the retail officers outside of that. And given this person assuming given that the agri-loan officer's productivity is probably lower given the distances in that. And how do you track and manage that or square that in your incentive scheme?
Mm-hmm. Mm-hmm. Okay. Regarding the currency risk, we finance the credit portfolio with our savings, which means our savings are in local currency as well. Mm-hmm. But it's clear that we are. This is an important risk for the bank, especially. Our investors have only invested in euros. This is a challenge, and this is one of the risk to be considered as well. Mm-hmm. Regarding the bonus scheme, we adapted the bonus scheme to each type of loan officer based on what we consider is achievable to be rewarded. So there is we work in a way that agro loan officers are not penalized because of the fact that they disbursed lower amounts. They receive a monthly target, and the bonus is based on that. So of course, loan officers, micro loan officers, urban loan officers have as well a bigger target.
Great. Just one last question to round out. I know you mentioned that your performance of your cash flow based loan is doing quite well at 2% par 30 as compared to the rest of the agri loan portfolio. Could you speak about what the difference is to the audience to give them an indication of how well your overall ag portfolio is doing, and then how that segment is doing vis-a-vis the ag portfolio, but also how your ag portfolio compares to the rest of your lending portfolio?
Mm-hmm. The difference is quite big. I mentioned the par 30 for the agricultural product line is 2%. We are above 4.5% for the total agricultural portfolio. So, which means as well that somehow the tool is reducing the risk and assessing properly the clients.
Yes, at a bit higher cost, I would imagine.
Yes, this is of course the consequence.
Mm-hmm. And how does the ag portfolio compare to the rest of the portfolio of Access Bank?
Slightly higher, but there are no big differences. So for the total bank, we are above around as well 4.5. Okay,
well, fantastic. Okay, well, Quentin, we're nearing the end of our session today. I would like to personally thank you for a very interesting presentation and engagement with you. To everyone that's still online, we will be making the recording available to everyone on this webinar and the PowerPoint presentation and the video on our website very shortly. We do this within, a couple hours of the webinar. Again, before ending today's session, I'd just like to remind you about our new agricultural finance video series we just launched. Hop on our website, or if you've received the information through our newsletter, please do check them out. They're freely available online, either via our website or via the AgriFin apps, both in iOS and for Android smart devices. These are great resources for bankers and others working in ag finance. You can use them in your training sessions. You can use them to educate people that may be a little bit cold on agricultural finance, especially with your EXCO committee members and your board members. It offers a range of topics on ag finance, from lending to farmers and assessing agricultural risk, all the way through designing different products. We have some videos on value chain financing and collateral management and warehouse receipts. So do take some time out. Lastly, the French and Spanish videos of the versions will be coming out shortly, so do keep that in mind as well. Before signing off, I would like to ask everyone to please let us know what you thought about today's webinar. I believe the questionnaire has been put up on the screen now. If you would take a few minutes to fill out the brief survey, it really, really helps us to gauge how we're doing and bring you a better webinar service and series in the future. So if you wouldn't mind taking 1 or 2 minutes to populate that, we would greatly appreciate it. In the meantime, if you have any remaining questions, please visit our website or send us an email at agrifin@theworldbank.org. We'll be sure to facilitate any questions you may have with the presenter, Quentin, or make his email available to you, and you can engage with him offline. So on behalf of all of the AgriFin team, I'd like to thank you again, Quentin, for taking time out in your very busy schedule to contribute to this knowledge exchange. The lessons today and the information that you've shared really helped to shape the way people and professionals approach their work. So thank you for contributing to that aim. We will be busy preparing for the next webinar, which will be about financing of irrigation systems from India, and we'll be sending information out about that shortly. So once again, thank you, Quentin. Thank you, everyone, for joining us today. We look forward to meeting you again in July. Have a good evening, afternoon, and morning. Bye-bye.